Assalamu alaikum. Welcome to lecture 6 of ATX. So, from lecture 3 to 5, I have covered income from sole trader and partnership. Now, we are moving on to the next type of income under income tax, which is property and investment income. Property and investment income falls under non savings income. So, that means it will be taxed at the non savings rate 20, 40, and 45%. Okay, but the way we calculate property and investment income are different compared to our trading profit and our employment income that I've covered in the previous 5 lectures. Now, in this lecture, we are going to focus on property income, furnished holiday accommodation, rent a room relief, property business losses, premiums received on a grant of a lease. All the 5 points I've mentioned were covered in taxation. This is just a quick revision. Wherever I have mentioned new in red, those are the sections which are included especially in ATX. It was not there in your taxation, they are new for ATX. So, real estate investment trust is new, tax free investments. Then we have enterprise investment scheme known as EIS. All the schemes, one of the scheme you might get in your ATX exam. So, make sure that you know the schemes. There are 3 different types of schemes and they are new for ATX and you must know it. The features, advantages, the differences, similarities. SEIS, Seed Enterprise Investment Scheme. Then we have Venture Capital Trust, VCT. These are new. Then how do you mitigate income tax liability using the schemes? And finally, the summary. So let us start with property. First, we'll be going through property income. Then property and investment are 2 separate types of income. Do not mix the two. Property income is separate, investment income is separate. So first we'll finish with property, then investment. Okay, because the sections of property and investment are more or less very similar, because most of the time we might hold a property for an investment purpose. Sometimes we might have a property for trading purpose. Most of the time it's for investment purpose we hold a property. Okay, so they have some similar nature to it, and also the sections are very small for property and investment. Unlike our self-employment income or employment income, they were a huge heading. Okay, property and investment are small sections. Okay, now property income. Under property income, we are going to study what are the allowable deductions, like how for trading profit in a self-employment income or under employment income we have some expenses that we could deduct, right? Donation to subscription to the professional body, donation to the charitable organization, like that we could deduct. Entertainment expenses. Okay, so like that, property income also has some allowable deductions. And by the way, whatever the type of income, you have to know the allowable deductions under each type of income. Okay, next is FHA, furnished holiday accommodation. This also comes under property income. Rent a room relief. Every type of income has some relief. Short release premium. Yes. And losses. Like how we have trading losses, we have property income loss also, how to deal with it. And then real estate investment trust, which is new for ATX. These are the tax efficient investments. If you invest in this, it's going to save your tax. Individual savings account. Individual savings account we have studied in my lecture 2. Okay, that you can save tax. Okay, it is a form of savings income. You can say up to 20,000 you can invest and it will be tax free. There's no income, it is exempt from income tax. Then we have EIS, Enterprise Investment Scheme. Then SEIS, Seed Enterprise Investment Scheme, and VCT, Venture Capital Trust. Now, property income. All income from your land and buildings will be taxed as a property income. Property income includes anything that you are receiving a rent on. It's your property income. For example, under a lease, you are getting a lease premium. I'm talking about short lease, not long lease. Long lease are excluded from this. If it's a short lease, it will be there. So it comes under property income. Okay, deduct. So rental income minus the expenses, allowable expenses. It could be under any tenancy or a lease agreement. Next, if you're receiving any premium for a short lease, it comes under property income. Then any profit that you are getting from a commercial letting. Remember, commercial letting. It can't be for residential purpose. Okay. For commercial letting, if you are getting any profit, known as furnished holiday accommodation. We'll study in detail what is this furnished holiday accommodation. Okay, in a while. So any profit from that is accounted under property income. Any rent received under rent a room scheme, property income. What is the basis of assessment for property income? Basis of assessment is if an individual or a partnership lets out a property or several properties, then whatever the profit you are getting from renting the properties is calculated as if the individual had a single trade. See, you might be having 5, 6 properties, but you accumulate all and say that is one trade. Okay, next. So you add up all, you accumulate all, sum up all the rental income from all the properties, you deduct all the related expenses, and you get the taxable property income. Now, rental income, your property income is based, it is taxable on a cash basis. That means rental income actually received during the tax year. And whatever the cash, even the related expenses are deductible on a cash basis. Expenses actually paid. And there is an alternative to it. Taxpayer can elect to go for accrual basis. Okay. But if the taxpayer's gross, I'm working, please mark the word gross. If the taxpayer's gross annual rent exceed 150,000, you don't have a choice. You have to go by accrual basis only. Then there is no option. Okay. Then you don't have to elect. Automatically it will be accrual basis. If you are less than 150,000, normally it's a cash basis, but you can elect for accrual basis also. Property income is always calculated on accrual basis for a company. Remember, for individual, property income is cash basis. But if it's a company, it's always why? Because for companies, very complex to go by cash basis. Companies don't deal with cash basis. Okay, if you have worked in a company, you will know that they are mostly accrual basis. So it's easier to work. Now, in your exam, okay, you will be told whether cash basis is used or not for property income. So you don't have to worry. If they don't say, if they are quiet, you should assume always the default position is cash basis. If it's not cash basis, in the exam you will be told that it's accrual basis. Remember, if the question is silent whether accrual or cash, choose the cash basis. If the question tells you it's a cash or an accrual basis, then use whatever the question tells you. Okay. Now, what if it's more than one property? A landlord has letting more than one property. Remember, you have to use the same basis. You can't use for one property cash, for one accrual. No. If you're having more than one property, for all the property, you have to use same basis. If you're choosing cash for one, for all, you have to choose cash. If it's accrual, for all, it's accrual. Now, it is also possible in certain circumstances for unincorporated business. Unincorporated always means sole trader partnership. I'm not talking about company here, okay? For sole trader and partnership, to elect to calculate trading profit on a cash basis. See, normally trading profit, if you have watched my lecture 3 and 4, trading profit are calculated on accrual basis for sole trade and partnership, right? But here, they can elect to calculate that trading profit on a cash basis. Because why? See, an individual might run two business. One, he might be running a trading business. One, he might be running a property business, right? So there, if he thinks that because I'm using cash basis for property, it's better to use cash for trading business. If he thinks like that, he has that flexibility. But it is not compulsory. It is not necessary that they have to choose the same basis for both property and trading business. No. He can choose accrual for trading and cash for property. But if he wants, he can choose, if he wants to elect to choose cash for trading because property is cash, that he can do. That flexibility is there. This is only a flexibility. I'm not saying it's compulsory that they have to choose the same basis for both business. No. Now, property income, as I told you, it comes under non-savings. It will be taxed at 20, 40 and 45% based on your taxable income. Now, these are the list of allowable deductions for property income. Okay, most of them, they are used for trading income also. Okay, these are the expenses allowable even for trading income also. So it says even in the trading income, if you have watched my lecture 3, it's there. So to be allowable, expenses must be wholly and exclusively incurred for the purpose of property business. In the trading business, the word just changed to trading business. Okay, here it's property, there it's trading, but everything word by word is same. There also, expenses has to be incurred wholly and exclusively for the purpose of the business. So it covers these items: insurance, agents fees and other management expenses. Yes, because we need insurance specifically for the property. We need agent fee. Then repairs are there for property. Then interest, repairs are not allowable deductions for trading income. Okay, because for trading income we don't have to repair, it's an expense that anyway we have to do. But for property we specifically have to repair. We have to keep on repairing our property. So it's an allowable deduction. Okay, then interest on a loan to acquire or improve the property. It is subject to some special rules, but it is allowable. Remember that interest on loan, you have to take that loan to acquire the property, and any interest on that loan only is allowable deduction, not interest on any other loan. It has to be for that property. And irrecoverable debt. Remember, irrecoverable debt is only allowed under accrual basis, because under cash basis you will be receiving the cash. Until you don't receive the cash, you are not receiving, you are not recognizing it. So there is no risk of irrecoverable debt in cash basis. Only under accrual basis only irrecoverable debt comes. Because under cash basis, the outstanding amount receivable would not have been taxed. Until you don't receive the cash, it will not be taxed to you, no? So there's no risk in cash basis. But in accrual basis, whether you have received or not, you will be taxed on the outstanding amount. That's why irrecoverable debt under accrual basis only you can deduct. Next, we have some more list. Any expenditure that is incurred before the letting start is allowable under normal pre-trading expenditure. These are somewhere before trading starts you can deduct. If a property is occupied for part of the year by the owner, remember, any expenses relating to the private use will not be allowed as a deduction. Anything to do with private use of the property, and you can't deduct. And where a property is not let at a full rent, maybe you are giving the property to a relative at a discount, what happens? Then any portion of the expenses that you have incurred by that relative will be disallowed. Why? Because it is not being wholly and exclusively for the purpose of the business. You're not incurring that expense. For example, let's say if the rent charge is 250, but the commercial rent is 1000. So only up to 25% of expenses will be allowed to deduct. Okay? Because out of that 1000, only 250 is allowable. Because you are paying less than the commercial rent. The rest 85% is not allowable. Next, in practice, HMRC would allow the expenses, but only up to the amount of the rent on that property. Coming to the capital expenditure. Next, so under cash basis, there is no difference between revenue and capital expenditure for plant and machinery. Okay, this is from the point of tax purpose. So expenditure on plant and machinery, except car, remember, exclude the car. We are only talking about plant and machinery. Okay, expenditure on plant and machinery that has been used in property business are allowable deduction. Okay, is an allowable deduction from income when paid. When paid, it's cash basis, that's why. So when you are paying for this expenditure on plant and machinery, you can deduct it from the income. This is capital expenditure. This capital expenditure also you can deduct from the income, rental income, property income. Next, This rule does not apply to number one, cars, number two, assets that are used, assets provided for use in residential property. You can't deduct. Example, furniture, TV. But for them, we have another type of relief for residential property that is known as replacement domestic item relief. We'll see that later. Now, in addition, capital expenditure on land and building is not an allowable deduction. Remember, any capital expenditure on land and building are not allowable deduction. So you have to distinguish between the two types of expenditure in land and buildings. One is cash basis, one is accrual. One is capital expenditure, one is revenue. For example, any repairs to the land and building are revenue expenditure. Any improvements to the building are capital expenditure. Just a minute. Okay. Now, these are the expenditure which are allowable. These are revenue expenditure. So earlier, there is a doubt I want to clear in the earlier slide. First bullet point, expenditure on plant and machinery used in a property business, such as tools used for the maintenance of the property, used for running the business is an allowable deduction. See, yes, under cash basis, there is no distinction between capital and revenue. But cash basis, there is no difference. Both will be taken as same. But what is allowable and what is not allowable? Revenue part, revenue expenditure on that plant and machinery is allowable. Capital is not allowable. Okay. For example, any cost that you have spent in running that property business, you can deduct because that running part is a revenue expenditure. But anything capital improvement is capital. You can't deduct. So repair expenditure allowable, improvement not allowable. Under accrual basis, the only difference is that expenditure on plant and machinery used in a property business, such as the tools used for the maintenance of the property, you can't deduct. But rather you can claim capital allowances under accrual basis. Now, cars. So let us move on to the cars. You can claim capital allowance for the car. So in this case, you can deduct the actual motoring cost. Petrol and insurance are also deductible. And alternative is you can claim approved mileage allowance from HMRC instead of claiming capital allowance and actual motoring cost. This approved mileage allowance I've explained in my lecture 2 when I was explaining you the employment income. Please go back to my lecture 2 and watch it out for clear understanding. And capital allowance I've finished in lecture 3 under self-employment income. Then this approved mileage allowance are same as those that can be used by employees also and traders to calculate actual motoring cost. It's the same mileage allowance that you have studied there is applicable here. Nothing new. Now, replacement domestic item relief. What does this mean? This is used for residential property. Any expenditure on assets that are used in residential property like furniture, TV, carpet, you can't deduct. But capital allowances are also not available for them. But instead, another relief is available. What is it? Replacement furniture relief or replacement domestic items relief. This is when you are letting a furnished residential. Okay, it is furnished also and it's a residential that you are letting. Then this relief is applicable. Now, so we'll see how this relief works. The relief allows a deduction from the replacement. So when you are replacing an asset, for example, you often have to replace a carpet or a furniture or a TV. Let's say after 3 years, then the cost of that replacement. Okay, from that cost of that replacement, you can deduct this relief. It is not the original accusation. It is from the replacement cost that you deduct. Okay. These are the allowable deduction. Replacement cost less any proceeds from the disposal of the original item. Now, remember the replacement cost that is allowed. It has to be similar. It has to be a cost of a similar item. Any improvement to the new item, that new replaced item, you can't take. It has to be same. Only the similar feature are comes under this relief. For example, you are taking, okay, but remember it is allowing for the modern equivalent. Okay, obviously in the modern equivalent there would be some additional feature to the replacement which was not there in the old. So that modern equivalent features, the cost of it would be taken into account. Let's say a washing machine. Okay, you are replacing a washing machine with a washer dryer. Okay, so only the cost of the replacement washing machine would qualify for this relief. Definitely you'll understand this with questions. Next, domestic items. These are the some of the domestic items that are acquired. It could be furniture, furnishing, household appliances like white goods, like carpet, curtains, kitchenware. Okay. However, fixtures, for example, any plant and machinery that is already fixed in that building are excluded from this relief. For example, boilers, radiators, they are excluded. You can't include them. And this relief, mind you, it is not applicable for furnished holiday lettings. Furnished holiday letting is for commercial purpose, and this is residential purpose. And also accommodation for which a rent room relief has been claimed, you can claim this relief. Only one relief you can claim. Either replacement domestic item relief or rent room relief. Both can be claimed. Now let us do a question. Test your understanding one. Here we have to use accrual and cash basis. Okay. So you have been given the rental income as 3,600 payable 6th of each month. Monthly rental income has been given. Now you have been given some cost, and in this cost you have some capital and revenue. Okay. Some expenses you have to deduct, some you don't have to. That's why you need to know all the types of costs that you can deduct and you can't. Don't simply take all the cost and deduct because it's given. No. Of course, you have to read the notes. Okay. So first let us go through the cost. We have cost of new garage. If you're very well aware of property income, by looking at this itself, you should be able to figure out whether you're using accrual or cash basis. You can't deduct cost of new garage. Why? It is a capital expenditure. So it's not deductible under any basis, cash or accrual. Coming to the insurance. Yes, insurance you can deduct. But the way you calculate insurance will be different under cash and accrual. So insurance, yes. Replacement freezer, yes. Even replacement freezer, you have to deduct under both. It's deductible under cash and accrual. New kitchen table, this you can't deduct. Why? You will not even get a replacement for it. Replacement furniture relief is not available for the cost of table. Why? It is a new item. It is not a replacement. It's a new kitchen table. New. The word new itself says you can't replace it. Next is the redecoration cost. Yes, redecoration cost is allowable. So you have to work on three costs: insurance, freezer, redecoration, and of course the rental income. These are the four things you have to work out. Okay. First note. This is the date when they have paid. Okay. These are the payment of dates. Tenant was late in paying the rent for March 2024. Okay, this is for this tax year. You have to take all the property income. Okay, Gil received that rent on 6th April. Tell me the 2023-24 tax year. It runs from 6th April 23 to 5th April 24. So because it runs from 5th April 24, this was received on 6th April, one day after. So this does not fall in this tax year. Rather, this falls in the next tax year, 24-25, under cash basis. Okay, because you are paying late under cash basis, you are only receiving it for 11 months. You are receiving it 1 month later. That means it falls under the next tax year. So 11 months of what is the monthly rental income given in the first line? 3,600. This is under cash basis. Accrual basis, you will write 3,600 only. So I'm going to write here cash basis, accrual basis. Rent received. So under cash, it's only for 11 months, which will be 3,300. But accrual, it does not affect when you receive, it is 3,600. Coming to the expenses. Start in the order given to you. Start with the insurance because cost of new garage is out. So when you're paying the insurance, remember insurance under cash basis. It is paid on 1st of June 2023. Doesn't matter for which time period, but it is paid in that current tax year, 480. So 480 under cash basis you can deduct. Under cash basis, no issue. Under accrual basis, time period is very relevant. See, note 2, it is related to insurance. From 5th July, see, insurance of 420. This insurance of 420 runs from the 30th June for the year from 5 July 22. This was paid on 1st June 2022. So insurance for the year means from 5th of July 2022 to one whole year. So 5th July 2022 to 4th July 2023. Remember, this falls in this tax year 23-24. How many months? Only April. It starts from 6th April. The month of April, May and June. 3 months. So 3 months of this falls in this tax year. It doesn't matter when you have paid it. Doesn't matter because under accrual basis. 420. So I will do the working here for insurance. Okay. 420 into 3 months because only 3 months of this tax year it falls. Plus, if you see here insurance, it is paid on 1st of June 23 running from the 5th July 23. For the year means 5 July 23 to 4th July 24. So if you see 4th July, so how many months are relevant for this tax year? Starting from 5th July 23. July, August, September, October, November, December, January, February, March, only 9 months. Only 9 months. The remaining 3 months falls in the next tax year, 24-25. It's not relevant for us. It is not this year because they asked for 23-24. So 9 months or 480 you have to take. Okay. It's not at all complicated. If you have understood, it's very easy. Okay. Looks like it's very complicated. No, it's not. You only have to work out the relevant period. So it would be 465. The insurance. Okay. Now the next expense that you have to deduct on the list is replacement freezer. This is paid on 1st November 23, this tax year, and nothing has been mentioned under the notes. So 380 from both you deduct. Replacement RF I'm writing. Next, redecoration cost. Redecoration cost incurred on 1st of March 24 was not paid until 1st May. See, it's not paid until 1st May. So this 750 will not be recorded under cash basis because it's not paid. But under accrual basis, you deduct 750 because it's relevant for this tax year. And here you will get 2440 and here you will get 2005. This is the property income, PI. Okay. The next on the list is financing cost for residential property. Here, owners of the residential property who live in their own property do not get a tax relief for their mortgage cost. Number one. Number two, owners of buy to let residential property do not get a deduction from income for their finance costs. Remember this. But tax relief is given on the finance cost at the basic rate. Basic rate is 20%. as a deduction from the taxpayer's final income tax liability. That means you can deduct this from the income tax liability. From the income, okay, income of the owners. They can't deduct the finance cost, but the tax relief that they get on that finance cost, that they can deduct from income tax liability. This is for the owners who buy and then let a residential property. We are in the residential property now. Focus your mind to residential property. Forget about commercial property now. Then, so this special rule applies to loans to acquire or improve a residential let property, and also to acquire equipment or assets used for the residential letting business. See, we are in the residential letting business. The next slide will be moving to furnished holiday accommodation. That is commercial letting business. There the rules are different. Okay. Here the older rule is when it's a residential letting business, the tax relief that you are getting on the finance cost, on the loan that you are taking for the residential property, you can deduct from the income tax. This is the rule. Whether you take a loan to acquire the property, whether you take a loan to improve the property, whether you take any equipment or assets to use in the residential let property, you can deduct the interest relief on that finance cost. Because if you are taking a loan, you'll be having an interest to pay, and that interest is always tax deductible. You get a tax relief on the interest. We all know that. So this is this benefit. Now, in that finance cost, any interest payable, such as any interest payable, as well as the incidental cost of obtaining that finance, obtaining that loan. For example, you might have to pay bank fees to get a loan to acquire that property. Even that is counted under finance cost. On that also you will get tax relief, not only the interest payable. So it's an added advantage, right? Isn't it? Now, remember, this special rules of deducting finance cost, the interest on the finance cost, is not applicable for companies. It is not applicable for commercial properties. It is not applicable for qualifying furnished holiday accommodation. Our next topic. Before we move on to furnished holiday accommodation, let us do a question on the financing cost for residential property. Illustration 1, financing cost. So here you have been given some cost with rental income and other types of income. For example, trading income of 50 and bank interest of 800. Okay. You have to calculate the income tax liability. The question, I think, is not copy pasted here, but the requirement is you have to calculate income tax liability. This is the requirement. That also after the reliefs, if you have any. Okay. So for this, since we have trading income, since we have bank interest, we have two types of income, savings and non-savings. So first we'll make a column and put the different types of income in the correct category. Okay. Let us quickly do that. Non-savings, savings, total. Okay. So first is trading income. It's under non-savings, 50,000, and total is 50,000. Then we have interest. Interest is 800. It's under savings. Then we have property income. It's better to put all non-savings first and then this interest later, but it's okay. Property income is, you have been given the annual rent of 15,000. You have to do a working here. Okay. Since you have done a working here, we'll put W like this and we'll do a working. Small working. Okay. Now we'll put it, I need the space. We'll put the working here. Okay. So property income, working. Okay. Rent. It's 15,000. It has been given here. Right, 15,000. Now these are the costs: agents fee, insurance, gardener's cost, interest on account to loan to acquire the property. So So we deduct this, this and this. This, keep it here for time being. We don't deduct the interest. Okay. So we'll deduct 1000, agent's fee, insurance 1500, and then we deduct the gardener's cost 1300. So the property cost is 11,200. This we put here, 11,200. 11,200. Now we put the total. Okay, 61, 200, 800, 62,000. Remember to deduct, this is total income. Now we have to deduct personal allowance from it. 12,570. Remember to take it from non-savings. This is most tax efficient, that's why. Then we have taxable income. Okay. It is 49,430. 800. 49,430. Sorry, this is 48,630. Okay, 48,630. Now we'll tax it. Okay, so first non-savings basic. If you see here, non-saving, it is 48,630. Out of which basic is 37,700 into what? 20%. 7,540. Then the balance 48,630 it has to be. The balance will go in the higher rate, 10,930. This is higher into 40%, 4,372. Now savings. Remember we have a nil rate band for savings because if you see the taxable income, it is higher rate. So he will get a savings nil rate band of 500 into 0. That means out of 800 of savings, 500 is nil rate band. So 300 balance is at 40% higher rate. 120. If you add up, it is 12,032. That's 800. Now we are going to get a relief that you can deduct. What is that relief? Basic rate tax relief on property income interest. Go back here. Remember this 7,500 we didn't deduct. On this we are going to get a 20% relief. Okay. So that we didn't deduct from income, but now we can deduct from our tax. From this. So deduct 7,500 into 20%, which is 1,500. 10,532 is the income tax liability. So now we have moved to furnished holiday accommodation, FHA. Okay, this is a commercial letting. We have finished the residential part. Now, this any income on this is taxable. It is taxable as property income, but it is treated as though profit earns from a separate trade. You don't take it under other property income and add all the property income. No. If you are getting any profit from FHA, this is taken separately. It's a separate trade. But under property income only it will be taxable. It is an earned income, not investment income. So, in the same way, for a normal property, cash basis should be used to calculate FHA income unless the gross rental income exceeds 150,000. Even for the other property also, it is the same. If it exists 150,000, the gross rental income, you use accrual basis automatically. In the exam, it should be assumed cash basis is used always. Like for normal property, how we assume cash basis, same for FHA also cash basis. That is the default assumption. Otherwise, the question will tell you. Now, what are the qualifying conditions for it to be a furnished holiday accommodation? Very important to know. See, in your ATX, they will not ask you what are the qualifying conditions. That has been taught in taxation. The only thing is you need to know so that you can do the correct treatment if furnished holiday accommodation is given to you, in order to identify whether something is a furnished holiday accommodation or not. Because then only you can work on it, right, with the correct tax rate. Otherwise, you might put it under some other things, some other category. That's why you need to know these qualifying conditions. But in the exam, it will not be asked. Okay. So a property has to be situated in UK or EEA, and it has to be furnished, and it should be let on a commercial basis. Number one. Second condition, it should be available for commercial letting to the public, not less than 210 days. That means it has to be 210 or more than 210 days a year. And it should actually be let for 105 days. That is the half of 210 a year. Excluding periods of long-term occupation. You should not take long-term occupation. Okay. We'll see what is this long-term occupation. Where a taxpayer owns more than one property, then how do you satisfy the 105 days test? This 105 days test is satisfied by seeing the average number of days for which the properties are let in the year is at least 105. That means you have 3 properties. So you divide it by 3 and see whether 105 days test has been met or not. You average it out, and average days has to be more than 105. Next, if the accommodation is, see, the accommodation normally is not let more than 31 days, more than 31 consecutive days. It should not be that one day you are staying, the other day you are going somewhere, again you are coming. In between you have breaks, not like that. 31 consecutive days, you should not let it to the same person. Okay, it is not normally let greater than 31 consecutive days. However, if during a 12-month period, okay, you are letting the property to the same person more than 31 consecutive days, then the aggregate of this long periods should not exceed 155 days in total. Now, the losses. Losses from FHA. Remember, the losses of FHA cannot be set against any other income. It should only be set against the profit from the same FHA business. Okay, you can carry it forward and offset it against the profit of FHA business. Next, UK losses. UK losses can only be set against future UK FHA income, and E losses can only be set against future EEFA income. So it makes sense, right? UK loss with UK FHA income, EA loss with EA FHA income. What are the advantages of this treatment? Why do an organization want their trade to be treated as FHA? There are some advantages. Number one is the profit that you earned will be treated as an earned income, like how you get from your employment income. The salary is an earned income, no? So now, the advantages of earned income. Number one, for the pension purpose. Okay, the profit are treated as a relevant earnings for pension relief purpose. You get a pension relief on that earnings. Whatever the profit you get on furnished holiday accommodation will be taken, that can be used to get a relief, pension relief. Not, see, any income are not eligible for pension relief. If you are carrying on a trade, you are having a trading profit. Trading profit, you can't claim pension relief for it. For pension relief, your employment income is taken and FHA. Next, finance cost. Next advantage is finance cost. Finance costs are fully deductible from income. That means there is no restriction to basic rate relief. See, in the just now, previously we have done a question where you got a 20% relief on 7,500, but that was a residential property. Here, there is no such relief. No such restriction. Fully you can deduct. Next, plant and machinery. So there is a deduction that is available for all plant and machinery, including furniture and furnishings also, if you are using cash basis. But if accrual basis is used, you can claim capital allowance. This is instead of replacement furniture relief. See, when it's a residential lettings, you get a replacement furniture relief. But if it's a commercial, like furnished holiday accommodation, you don't get that relief, but instead you get this relief. Either deduct all the expenses if you're using cash basis, or if it's accrual basis, you claim capital allowance. Now, property is treated as a business asset for CGT purpose. If you are selling of this FHA, you get a business relief. You get a relief from the point of CGT purpose, capital gain tax purpose. So when you're disposing FHA, you get this kind of relief, business asset disposal relief. This I have explained it to you in my lecture 4 when you were disposing a sole trader. There we get this relief. Why? Because sole trader, it's a trading business. It's a business asset. Same way, furnished holiday accommodation, when you're disposing it, it's a business asset for which you get a business asset disposal relief. Business asset disposal relief means you have to pay CGT only 10%, not 20%. Next, you get a rolled over relief. For rolled over relief, I will be teaching you in capital gain tax lectures, but briefly, rolled over relief is when you are not paying the CGT tax immediately. It is rolled over. It is deferred. The gain is deferred against the future disposal. Gift holdover relief. When you're gifting to someone, you are getting a relief on it. But later, it will be payable. Next, business property relief for inheritance tax may be available. IST is inheritance tax, but only if it runs as a business or there's a substantial involvement by the owner and additional services are provided like cleaning, laundry, TV, light and heat and activities. Then business property relief for inheritance tax will be available. This is from the point of FHA. If you are running the furnished holiday accommodation as a business, if there's a substantial involvement by the owner, if additional services are provided in that FHA treatment like cleaning, laundry, from the inheritance tax point of view, you get a business property relief. Okay. Next is renter room relief. Renter room relief means when an individual is letting a furnished accommodation. See, this is different from furnished holiday accommodation. Here, it is the individual's main residence that they are renting. That means you are also living in that, and then you are renting it. So for that, this is also like any other property, cash basis. So a good thing is in property income, everything is cash basis, unless your rental income is more than 150,000. So if your gross receipt, rental receipt, gross means before you deduct your expense and capital allowance. If your gross rental receipt is more than 7,500, you can't claim this relief. But if it's 7,500 or less, your entire income is exempt from tax. This is known as renter room relief. And individual can even elect also to ignore this exemption. That means they are saying that they don't want this exemption. For example, they have incurred a loss this year. So it's no use of taking this exemption. They anyway don't have to pay tax because it's a loss. But if your gross annual receipt is more than 7,500, it is not exempt. Individual can choose how they want to be taxed. Number one, either they are paying tax on the excess, that means anything more than 7,500. For example, your gross rent is 8,000. So you are paying the difference on not the 8,000. 8,000 minus 7,500. That is the excess is 500. On that 500 you are paying tax. Or you are being taxed in the ordinary way. How? Rent less the expenses, less replacement furniture relief. Why replacement furniture relief? This is your own main residence. You are living there. So obviously you will be replacing some furniture. For that you might be getting relief. So that's why rent less expenses, less replacement furniture relief. Deduct and whatever the rent you get, on that you pay tax. Or on the excess more than 7,500. You can choose. Now, for married couples, they can either have all the rent that is being paid to one partner. That means only one partner will have that full limit of 7,500. Or they can divide between them. That means this 7,500 limit will be divided among the two. That means each one of them Both the partners will be having 3,750 as a relief. Now, business property loss. The next one. You aggregate all the profit and losses of all the properties, and if there's an overall loss, property income will be nil. And loss is automatically carried forward and set against the first available future property income. It has to be property income, not any other income. Now, this is the summary of property income. So we have finished property income with this before we move on to a question. So rental income, rent received minus expenses is the income. You aggregate all the properties except one, that is furnished holiday accommodation. And then it is treated taxed as non-savings income. You can elect for accrual basis. But if it's more than 150,000, gross rent is more than 150,000, compulsory it is accrual basis. Now, allowable deductions. Any expenses incurred wholly and exclusively for property business, cars. See, for cars, you can claim capital allowance or running cost or approved mileage allowance. This approved mileage allowance I've covered in lecture 2 when I taught you employment income. And finance cost. For residential property, it is restricted. That means only the basic up to basic rate you can reduce from the income tax. Okay, that is 20%. And expenses. You have to apportion the expenses if there's a private use by the owner or it is not let at a full rent. For furnishing, there's a replacement furniture relief. You can deduct. There's a deduction for replacement of furnishing and no deduction for initial purchase. Remember, initially when you're purchasing a new asset, no relief is there. When you are second time you are replacing it, for example, first time you are buying a furniture, no relief. Second time you want to replace that furniture, yes, relief is there. Next is property losses. Overall net loss on all properties. Property income will be nil, loss is carried forward, set against the property income. Next, FHA. It is treated as a separate trade. It is an earned income. Conditions are it has to be in UK or EEA. It has to be let on commercial basis. It should be furnished, available for more than or equal to 210 days. Actually, it should be let for 105 days. It should not normally let for long-term occupation. Long-term occupation means to any person more than 31 consecutive days. And if it's a long-term occupation, the total should not be more than 155 days in 12 months. Advantages is for pension, from the point of pension, you get a relief there. Okay. So this earning will be taken for pension relief. And full cost of furniture is allowed if you are using cash basis. And if it's accrual, capital allowances. It is a business asset. It is treated as business asset from the point of capital gain tax. That means you can save capital gain tax. And you get a business asset disposal relief, rolled over relief, gift holdover relief. Next, losses. Overall net loss, property income nil, losses carried forward, set against the first UK or EE property. Okay, UA profits only. Remember, UK and EE, they are separate trades. Do not mix the two. UK trade, UK loss you can't set against FHA profit. Sorry, EEA profit, and EA losses you can't set against UK profit. They're separate. Then rent a room relief. This is you are letting a furnished room but in a main residence. Gross income has to be less than or equal to 7,500 to get the exemption. And you can elect for the loss. If you're having a loss, you might elect you don't want this exemption. Gross income more than 7,500, you can choose how you want to be taxed. So it is better to be assessed on the lower of. You are taxed. If you're seeing whichever is giving a lower figure, you choose that one. Normal rental income, that means normally take the income, deduct the expense, deduct the furniture relief, replacement furniture relief, or rent less than 7,500. That means the excess on the excess, anything more than 7,500, let's say 9,000. So 9,000 minus 7,500. Now, before we move on to premiums received on shortlist, let us do a small question. Illustration 2, property business loss. So here we have been given the income of 2 years and expenses of the 2 years. You have to calculate property income or loss for both the tax years. Okay, Sheila owns 3 properties. 1 property, 2 property, 3. Remember, one single person owning a multiple property, you aggregate all income, aggregate all expense, then deduct that income and expense, you get one profit for each tax year. So let us quickly do that. Okay, so for this tax year we'll be adding 1200 with 450 and 3150. It would be 4800 is the property income. And for this year, 800 plus 1750 plus 2250, 5100. The total expense for 2022 and 23, just add all this. It's 450. Sorry, it's 5250. I'm sorry. 5250 and 4550. So now you have to deduct this expense from this income, this expense from this income. So you deduct this from this and this from this. And the ultimate profit for 22-23 is 0. Why? If you see, this is 4800, but this is 5250. Expenses are more than income. So property income would be nil, 0. You can't show a negative figure. 23-24, it is 5100 minus 4550. So it is 100. Property income is 100. What is the difference? 4800 minus 5250. The loss is 450. This is the loss. Okay. Remember this loss, sorry, I'm sorry. This profit is 550. And here you are having a loss of 450, but you are showing an income of property income as 0. So 450 loss and 550 income this year. So you set off this loss 450. Loss carried forward 450. Out of this 450 loss, you can set this 450 loss against this year's income. So you are left with 100 then. 100 property income for 23-24 after setting 450 from 550 income 100. So now from furnished holiday accommodation, rent a room relief, we are moving on to premium received on short lease. Now, a lease premium is a lump sum payment that is made by the tenant to the landlord in consideration of granting a lease. So the receipt of that premium, we are saying a short lease. If it's a short lease means equal to or less than 50 years. Anything more than 50 years is long lease, that is not accountable here. Short lease has both income tax and capital gain tax consequences. And if it's a long lease, no income tax consequences, but it is chargeable to capital gain tax. Now, remember, this lecture will only consider income tax consequences. CGD aspect of granting lease are not asked in your exam. Short lease premium. Okay, so part of the premium received will be treated as a rental income, whether you use cash or accrual basis. So the amount taxable, so even this comes under property income if you are giving a lease. Okay, this is how you calculate the taxable amount. Premium, you deduct premium into 2%. This is fixed. Okay, don't ask me why 2%. This rule is fixed. So premium, whatever the premium you have, take 2% of it, multiply the duration of lease minus 1. You deduct it from premium and you get the property income. For short-term lease, this is how you get the property income. Under each set, whether it is furnished holiday accommodation, whether it is rent a room relief, whether it is normal property income, you should know how to get the taxable amount. And for lease. Now, what is the duration of lease? Duration of lease, you should always take the complete years. Don't take decimals. Ignore the parts of a year. If it say 3.5 years, you should take 3. Alternative calculation. Premium multiplied by 51 minus n. N stands for number of years. Divide by 50. Okay. N is the length of lease in whole years. Length of lease. Anti-avoidance legislation provides that where the lease can be terminated at some date during the lease, it's possible. Either party could terminate the lease before the lease period actually was supposed to end, right? So that time you take the period of the lease to the earliest date on which the lease may be terminated. That means from the grant of the lease to the date the lease is terminated. That is known as the length of lease that time, not the original length of lease. Now let us do question on this before we move on to our next subtopic. So here we have two questions, test your understanding 2, test your understanding 3. 2 is a short which specifically works on lease premium. Test your understanding 3 works on furnished holiday accommodation and is a long one. So test your understanding 2, you have to calculate Rodney's property income. Okay, it's a 21-year lease and premium is 10,500. There is another lease with 14 years and 2 months left to run, premium of 30,000. So let us quickly do that. First we'll work out the 21-year lease. Okay, so 21-year lease. Okay, so first is premium. This is the formula we have studied just now, is 10,500. Deduct premium, that's 10,500 multiplied by 2% into number of length of the lease minus 1. So length of the lease is 21 minus 1, 4,200, which is 6,300. Now 14-year lease. Premium is 30,000. Work out the same. 30,000 into 2%. They told 14 years and 2 months. You have to take 14 years. It has to be whole year minus 1. So minus 7,800. It is 22,200. Add both the leases. It is 28,500. This is the property income. I will show you the alternative calculation, even though in exam you just have to show one method. So for 21-year lease, okay, another one is 51 minus n. N is 21 here. Divide by 50. This method is fixed into the premium. So you will get 6,300. This is the same thing here. Next, for 14-year lease, you only have to change this to 14. That's it. 51 minus 14 divided by 50, and this becomes 30,000. It would be 22,500. Same as this one. Sorry, 22,200. You will still get the same property income. Moving to test understanding 3. There are two requirements. Briefly explain whether house 1 will qualify for furnished holiday accommodations or not. To say, you have to go by the conditions. This is what the question is asking you. State the tax advantage of the house being so treated. Second, the property loss. You have to calculate property loss. And advise, not only calculate, advise of possible ways of relieving the loss. So there are two houses here. One is house 1, the other one is house 2. Okay. So now, house 1 is furnished holiday accommodation. House 2 is a let furnished. So we'll see. House 1, letting for 42 weeks. Actually let for 16 weeks. 200 per week. During 10 weeks, house was not available for letting. And it was occupied by rent-free by Jane's sister. Running cost is consist of council tax of 730, insurance of 310, advertising 545. House 2 was unoccupied from this date to this date due to a serious flood. As a result, 7,465 was spent on repairs. Now on this date, House was let on a 4-year lease. Premium 4,000, rent is 8,600 per month, receivable quarterly in advance. Immediately after the purchase, Jean furnished the two houses at a cost 5,200 per house, rented out one of the room of his main residence. He received rent of 7,850. Allowances. Allowable expenditure is 825. You need to break this big chunk of information into separate parts. Otherwise, you will not be able to deal with it. First requirement was asking about house 1. So just think about house 1. Okay. First, house 1, whether it is FHA. Second, advantages. So first, I'm going to write about housewife, whether it qualifies for FHA or not. So just keep on writing the condition one after the other. I'm not writing it down, but I will just tell you. Okay. So you have to say whether it is likely that it will be treated as FHA or unlikely. So in this case, it is likely that they'll be regarded as FHA, furnished holiday accommodation. Why? Because it means number 1, 2, 3, this conditions. That's why you have to know what are the conditions. Number 1. What is the number 1 condition? Location. What is the number 1 condition? It is the location. UK or EEA. You have to see where it is situated. So it is situated here. And it is furnished. They've mentioned. Where the question does not say whether it is situated in UK or elsewhere. See, if it is overseas, they will tell you the country. Okay. If it's UK, sometimes they might say it's UK, sometimes they are silent. If they are silent, assume it's UK. Okay. Furnished and it is let on commercial basis. All this condition is satisfied. Number 2, second condition. Available for letting. How many days it has to be? Greater than 210 days. Whether this is satisfied or not. This is in days. Your case study is in weeks. So to know that, go here. Actually let for, no, available for letting 42 weeks. 42 into 7. 294. It's 294 days. You have to convert this into days to check. Yes, it's more than 210 days. You can even write 294 days. Wait a minute. Sorry. 294 days. Second, actual let greater than 105 days. So here, actually let is 16 weeks. 16 into 7. 112. That's 112. Yes, it's more than 105 days. Okay. 112 days. What's the next one? How long that person occupied. So sometimes from case study is not clear. If it's not clear, write it. Like in this case, it is not clear. How long occupation? I'm just writing in short, you just write the whole sentence. How long the person occupied the house. Okay, we are just assuming there are no single lettings of more than 31 days. We are not letting to a same person consecutively for more than 31 days. We're just assuming why. Question did not say anything. When question does not say whether we are letting to a same person more than 31 days or not, assume we haven't let it. Okay, so the house will be FHA based on 1, 2, 3, 4. These 4 conditions. Now, 4 conditions satisfied. 1, 2, 3, 4. Coming to the advantages. So we'll just write 3 advantages. What is the first advantage? It will be an earnings, qualified for earnings for pension relief. Second advantage, on disposal, when you are disposing it, the house will qualify for business asset disposal relief, BADR. Not only that, rolled over relief and gift relief are available provided conditions are met. Okay, conditions for the relief has to be met. Number 3, full deduction. Full deduction will be available for plant and machinery. This is even more beneficial than replacement furniture relief also. Coming to the second part, calculate their property loss. Okay, so to calculate the property loss, we need all income and all expenses. So let us quickly do that. Rent received. This is from house 1. Okay. See, we are actually let for 16 weeks and we are getting 200. Okay. So it is 16 into 200, which is 3,200. Now all expenses, allowable expenses, council tax, insurance, advertising, cost of furniture. Okay. So what is the council tax? Remember, all these expenses has to be time apportioned except advertising. Okay. So now we'll go to the council tax and see. Council tax 730. Okay. It is available for letting for 42 weeks only. See, out of how many weeks are there in a year? 52. Out of that 52, it is let for 42 and it is not available for letting for 10 weeks. So you only have to take the portion when it was actually let, and on that only we have to take the council tax. Council tax is 730 into 42 weeks it was let out of 52 in a year. Okay, 590. Next, insurance. Insurance also same, 42 weeks, but insurance is 310. Advertising we take the full cost, 545. Because advertising we do for the whole year. We can't apportion like that. 310 into 42 divided by 52. 250. Advertising 545. And cost of furniture also we do that. What is the cost of furniture? 5,200. 5,200 per house. This is for one. Okay. So 5,200 into 42 divided by 52 weeks. 4,200. Once you deduct this, you are getting a loss. 2,385. It's a loss. Now looking at other property income. This is FHA. Okay, this is related to house 1. That's why we are keeping it separate from other property income. Do not mix the two. Okay, other property income, rent received. This is house 2. What is the house 2? How much they are getting? So rent received is 8,600. See, this is after house 2 they have mentioned. This is about house 2 they are talking. Okay, they are receiving this much of rent. Receivable quarterly in advance. So how many months they are taking? This is on 1st of Feb. Okay, so they are receiving a quarterly in advance. For 3 months, they are receiving in advance. That means in this tax year, it's a cash basis. So we are taking their 3 months. Only out of 8,600, we are taking the 3 months. Okay, so 8,600, 3 months, which is 2,150. Now the lease premium. For lease premium, we are going to do a separate working. So we'll put W here. Okay, working. Now, so what is the lease premium? Lease premium is 4,000 and it's for 4 years. So according to the working premium multiplied by, we'll do the alternate method, 51 minus 4 divided by 50, which is 3,760. Okay, so 3,760 is the lease premium. This will add with the rent from house 2. Then we have allowable expenses, the repairs, which we have to deduct. So the repairs are 7,465. This one. House 2 was unoccupied and this much was spent on repairs. Okay. So now it is 7,465. 1,555. It's a loss. Now we have another one, which is rent from furnished room. So rent from furnished room, and it is 7,850. Okay. We have an option. Okay. We have to choose the lower of. So if you go by 7,850, 825. Okay, it would be 7,035. 7,025, I'm sorry. And if you go by the excess, 7,850, if you take it over 7,500, it is 350. So which one is higher? Lower, this one. The excess. If you check 7,850, which is gross rental, it's more than 7,500. You pay on excess. Excess is 350. But if you go by the normal rule, 7,850 minus 825, it is on this you have to pay 7,025. So this one is lower, 350. So we'll go by that relief, rent a room relief. Okay. So it is 7,850. The relief, I'm not writing the name of the relief, it's rent a room relief, 7,500, which is 350. So if you add 350 with this, it reduces, the loss somewhat reduces, but it's a property loss altogether. If you take the rent a room, rent from furnished room, then lease, then rent received from house 2 and house 1, if you add all, this is what it is. Okay. So there is a loss from furnished holiday accommodation also and property. Remember, house 1 you can't add with house 2 lease premium and this rent from furnished room. This one is kept separate. Okay, this loss is kept separate from that property loss, because this you can only get it relieved, you carry forward and it gets relieved against FHA UK property. Okay, and what about the property loss? This you can set it off against future property income. Okay. So the next section that we are moving towards is Real Estate Investment Trust, REIT. This is a new section in ATX, so I'm going to go a little slow in this part. Okay. And it's just one slide and then we have a question. So this gives investor the opportunity to invest in a quoted property business setup as an investment trust. So slowly we are moving from property to investment income. This lecture is based on two types of income: property, investment. Property we have finished. Now we are moving towards investment. Okay. So they can elect, and REIT can elect for their income or gains from its investment properties to be exempt from corporation tax. Dividends received by an individual out of the profits of REIT are not treated like other dividend. They're kept separate. Instead, the income is treated as property income, taxed as non-savings, but not savings and non-dividend, okay? And receive net of 20% tax. Now let us do a question. Illustration 3. So in illustration 3, individual receives a dividend of 1200 from REIT. Okay? So because it is received net, you have to gross it up. Okay? This is how you gross it up. Multiplied by 100 divided by 80 because it is netted of 20%. This is how you always gross up. Multiply by 100 divide by 80 because 20% is the tax. So this is the gross amount, 1500. Definitely it makes sense because it has to be more than 1200. It can't be less than 1200. Why am I telling you this? Because some of you might do it the other way around. You will take 80 divided by 100 and multiply it by 1200. No, that means you are taking 80% of it. That means you are cutting tax twice. Already you have taken tax from an amount. Okay, now you are doing it again. So I will show you how it works. Check whether it's correct or not. If you take 1500 and take 20% of it, okay, just take 20% of it. It is 300, right? 300. So if we take minus 300 from it, it would be 1200. This is the net figure. Oh, another way of checking is after tax. Take 80% and check. It would be 1200, right? So now this is the subject you want to find out. Gross amount. Just say this is why you don't know the amount. You can always work backwards. So multiply, cross multiplication, then they divide. That's why 1200 multiplied by 100 divided by 80. Okay. Now, so this income could be taxed at 20, could be taxed at, see, even if it's dividend, don't get confused with the dividend rates. Dividend from REIT will always be taxed at non-savings, 20, 40, 45%. And this depend on the, at what rate they are, the individual. Okay. So what is the tax? The tax is 300. So he's going to get a tax credit of 300. And it can be repaid if relevant. This can be repaid back if it's relevant. Okay. This is how it is done. Now let us go to our next part. So now we are moving from REIT to tax-free investments. Tax-free investment, either the tax is free or the income is exempt. So these are the following four types. Interest on an S&I savings certificate. Income from individual savings account. Dividends from venture capital trust. Income tax repayment supplement. That means anything. Any income tax repayment that you are getting, it is tax free. It is free from tax, exempt from tax. Okay. Premium bond, national lottery, betting winnings. These are exempt. These are exempt income. First, we'll go through ISA. How it works and what it is. This can be operated by any individual above 18 or over. But if it's a cash individual savings account, then it's 16 or over. Who must be resident in UK? These are the tax relief and ISA offers. Number one, income. Okay, the income of ISA. See, if you are having a share ISA, stock ISA, you are getting a dividend, and if you are having a cash, you are having an interest. Both the type of income are exempt from income tax. Whether you receive interest on ISA, whether you receive dividend, they are exempt from income tax. Number two, if you are disposing this ISA, it is exempt from capital gain tax also. And good thing is there is no minimum holding period that says that you have to hold this for this much for it to be tax free, nothing like that. So you can withdraw anytime from the account. These are the types of an ISA, okay, can be made of the following component. Cash, like bank and building society accounts, NSA, okay, where the income is not exempt from tax. 16 and 17 can invest in cash ISAs. Only they can invest in cash ISA. Stocks and shares. This is the second type that we have. Stock, shares, and insurance products. Here, investment is allowed in shares and securities listed on a stock exchange anywhere in the world. Unlisted, remember, unlisted shares and shares that are traded on AMI, alternative investment market, they do not qualify for this. Now, what is the subscription limit? It is 20,000 for this tax year. Annual subscription limit. That means maximum amount an individual can invest in ISA and get it tax free is 20,000. This you can also tell in your tax planning also, okay, where you are having taxable income to transfer it to ISA. Next, spouses have their own limits. That means both the spouses will have 20,000, and this you can transfer also on the death of one spouse. If you are having both cash and share ISA together, the total has to be 20,000. Okay, you can take any combination of cash and share up to 20,000. Now, ISA and income tax nil rate band. There is an issue with it. See, the tax advantages that you used to enjoy in individual savings account is removed. Why? Because the tax authority have introduced the two nil rate band known as savings income nil rate band and dividend nil rate band. This I've explained to you in my lecture 1 of ATX. So because of this two nil rate band, advantages for some taxpayers has been removed that ISA offers. Cash ISA. Okay. See, basic and higher rate taxpayer only get this savings nil rate band. Okay. So if you invest in cash ISA, it no longer provides a tax benefit. Why? Because savings income within the nil rate band is taxed at 0%. It's anyway taxed at 0%. So you're investing in cash ISA and this is no much of a difference, because ultimately there it is exempt up to 20,000, here it is exempt. Here it is taxed at 0%. Next, for additional rate taxpayers, this could be beneficial. ISA could be beneficial for additional rate taxpayers only. Why? Because they are not entitled to savings nil rate band. So for those taxpayers who are additional rate taxpayers or whose savings nil rate band has been fully utilized, individual savings account is only beneficial for them. Just not beneficial for basic and high rate taxpayer, because they will get savings nil rate band. Coming to stocks. For stocks, they are going to have dividend, right? So we'll work about dividend nil rate band when it's for stocks and shares ISA. Okay. So here, dividend income within the nil rate band will be taxed at 0% up to 1,000, first 1,000. So here also, it is for those taxpayers who have utilized the dividend nil rate band. For them, ISA will be taxable, will be beneficial. The stocks and the shares ISA. See, unlike savings nil rate band, here we don't have a limit that you have to be basically at high taxpayer only. You have to be at a higher rate to get the benefit. No, 1,000, irrespective of what is your taxable income, you will get 0%. Okay. In addition, chargeable gains that are made within the stocks and the shares ISA are exempt from capital gain tax. So therefore, it will be advantageous to the taxpayer to make the chargeable gain in excess of the annual exempt amount. under ISA because it will be exempt anyway. Now, when you're transferring the ISA allowance to the spouse on death, yes, the surviving spouse can claim the unused individual savings account of their spouse who is dead now. Okay, remember the IS savings has to be at the time of their death. Only that much they can claim, not the entire 20,000. So this means ISA savings can be transferred to the surviving spouse and it is tax free. They will still retain their beneficial tax treatment. So in a way it's good. But spouses will be entitled to the allowance even if the ISA assets are left to someone else. This is a good thing. ISA assets could be with anyone, but still ISA allowance would be transferred to the spouse only. A claim must be made for the additional allowance. If you want to make an additional allowance, you have to make a claim, the surviving spouse. Now we are moving on to the next very important topic from the point of ATX. Enterprise Investment Scheme, known as EIS, very famously. Why is this scheme? How does this scheme work? What does it do? What are the features? What are the advantages, disadvantages? We'll see. Now, this scheme encourages the investor to subscribe for new shares in unquoted trading company. Please mark the words. It has to be new shares, it has to be a trading company, but unquoted trading company, not quoted. Next. So because the investor is committing their whole investment to one company only, it's a very high risk investment, isn't it? Because we don't even have a track record of that. They might not have a track record, they might be a new company. And even the shares are unquoted, so it's more risky. So unless the shares become quoted, investor can't realize the investment easily. A successful company, however, may carry high returns. Yes, once you become successful, yes, high returns are there which investors will get, but high risk is also there. Now, these are the conditions that needs to be satisfied for you to qualify for the scheme. You need to know these conditions. Number one, investor must subscribe in cash for new ordinary shares in a qualifying company, not any company. Company needs to be a qualifying company. You should not be an employee or the director of the company. You have to be independent of the company at the time of the first share issue. Not You should not already hold shares in the company at the time of investment. You can't already hold shares in the company where you are going to invest. If it is so, you're not eligible. Unless the shares held by the investor are qualifying EIS or CDIS shares. It is possible that you are independent of the company, you're not holding shares in the, but the shares that are held by the investor are qualifying EIS shares or CDIS shares. Now, you should have an interest of 30% or less in the company's ordinary share capital. Ordinary share capital OSC. These are the tax consequences. We'll see from the point of income tax and capital gain tax. Both. First income tax, then we'll work on the capital gain tax. Income taxes, you are going to get a 30% relief. Whatever the cost of the shares that you have subscribed for, up to 30% you can deduct from your income tax liability. What is the investment that is eligible for tax relief? Maximum of 1 million per tax year. Up to 1 million you can invest. Maximum investment. That means maximum 1 million means 1 million. If you take 30% of it, 300. That means up to 300 you can reduce the tax. This is the maximum. You can't go beyond this under EIS. You deduct this from income tax liability, not income. And you can even reduce your liability to nil. Suppose your income tax liability was 300,000. Now you have reduced 300. So it's nil. But you cannot create a tax repayment. That means, let's say you are having an income tax liability of 500. Okay. Sorry, 200. Income tax reduces 300. So it's a negative 100,000. You can't get a tax repayment for that. Where you have paid more. You can't claim for a tax repayment. No, that you can't do. Any investor may elect to carry back the amount invested to the previous year. Yes, you can elect to carry back the amount that you've invested to the previous year. But You cannot get relief on more than 1 million in any one tax year. Relief is fixed for 1 million only. No matter if you go back, you can't get more than 1 million. Relief for more than 1 million in any tax year. Next, we have more consequences. This claim for EIS income tax relief, they are normally made on the self-assessment tax return only. And it can be made up to 5 years. Please remember the date, up to 5 years. After 31st Jan following the end of the tax in which the shares are issued. Let's say you have issued the shares this year, this tax year. That means that is 31st Jan. So 31st Jan 2034 shares issued in the tax year 23-24. If you have issued for 23-24, 5 years after 31st January following the end of the tax year. So for 23-24, what is the 31st Jan? Following the end of the day. End of the tax year for 23-24 is 5th of April, right? 5th of April 24. 31st Jan after that. 31st Jan means 31st Jan 2025. So 5 years from there, 31st Jan 2030. That's how you calculate. First take the tax year end. Okay, 31st Jan after that tax year. So 31st Jan after 23-24 tax year means 31st Jan 2025. From there calculate another 5 year. 31st Jan 2030. This is how you calculate. Up to that time you can claim. Okay. Next. Note that dividends that are received from EIS investment, they are taxable in the normal way. Now, capital gain tax. Before we move on to capital gain tax, let us do question on income tax. Test your understanding 4. Here you have to state the amount of EIS relief for the tax year, assuming you're not carrying it back to the last tax year. Now, she is not an employee, does not own any shares in A Limited, subscribes for 10,000 new ordinary shares, which is a 1% interest, for 30,000. Qualifying EIS company, income tax liability is 14,000. So remember, she have invested how much? 30,000. So only up to 30% on 30,000, which is 9,000. This she can deduct from what? 14,000. So 14,000 minus 9,000 is 5,000. This is her income tax liability now. Relief is up to 9,000. Now we are moving to the tax consequences CGT. Okay. So when we are disposing the shares, okay, the capital gain on the disposal of shares in a qualifying companies are exempt. But for it to be exempt, conditions are there. Holding period is there. What is it? The shares have to be held for 3 years. Otherwise, it will not be exempt. But capital gain are exempt, but capital losses are always allowable. Capital gain are exempt only if you held the shares for 3 years. But whether you held for 3 years or less than 3 years or more than 3 years, capital losses are always allowable. Next, when you're calculating a capital loss on disposal of EIS share, the cost of the share must be reduced by the amount of EIS relief that was claimed and has not been withdrawn. Originally, the amount of EIS relief that you have claimed only you have to deduct from the cost of share, not the amount that is withdrawn. Because later we can even withdraw this relief. We'll see later regarding the withdrawal of this EIS relief. This, if conditions are not met later on, you can withdraw the relief. That means you have to do an adjustment now. Next, you have to make an election. An election can be made for capital losses to be relieved against total income in exactly the same way how trading losses are dealt with. Trading losses we relief against total income. Same way, even capital losses. This is a capital loss. You can make an election to treat the capital loss as trading loss and get it relief against total income. Now, EIS reinvestment relief. There is another relief. EIS relief is already there. Another is EIS reinvestment relief. Same way we have for SEIS also. That's why I'm going a little slow here so that there you will understand it better. The only thing is percentages and one two conditions are different. Rest everything is same. EIS and SEIS, the way it operates. Now, if proceeds, let's say when you're disposing a chargeable asset, okay, so any proceeds that you are receiving, that proceed you are using to reinvest in EIS share, that is known as EIS reinvestment. So when you are reinvesting, you get a relief. That's why it is known as EIS reinvestment relief. When you are reinvesting the proceed of the disposal of chargeable asset, only reinvesting in EIS share, not any other share, okay. So it is possible that time to defer some or all of the gain arising on that asset, arising on that new asset that you are purchasing. This is how it works. Individual can choose to defer any amount of capital gain on any asset. That's good. Flexibility is there. If qualifying EIS shares are subscribed for, the relief cannot exceed the amount invested. Remember, relief cannot exceed the amount invested. Okay. Now, the relief is lowest of the gain, the amount invested in EIS share, and any smaller amount chosen. Lowest is that EIS reinvestment relief. And any amount not deferred will be charged to capital gain tax in the normal way. Deferred gain is not deducted. See, usually what do? If you can recall from your taxation, rolled over relief, we deduct that gain from the base cost of the shares. But here, deferred gain is not deducted from the base cost of EIS share. Rather, the gain is simply frozen. Okay, and it becomes chargeable on the occurrence of one of this event later on. Okay, so these events are listed later in this lecture. Later in this lecture, the events will be listed. What are those events? When one of that event occurs, your gain that time becomes chargeable. You just keep the gain now. Calculate the gain and keep it somewhere. It's frozen. Although the capital gain tax on the disposal is only deferred, the initial relief is effectively 40 or 50%. How? See, 30% from income tax and could be 10 or 20% from CGT deferred based on whatever your CGT you are paying. So if it's 10, then 30 and 10, 40. If it's 20, 30 and 20, 50. Only CGT could be different, 10 or 20. Income is always 30% only. So initial relief could be 40 or 50%. This is the initial relief. Okay. Now, any gain arising on the actual EI share disposed is exempt from CGT, provided shares has been held for at least 3 years. EIS reinvestment relief is not automatic and must be claimed. Anything not automatic, you have to claim. Remember, EIS reinvestment relief, you have to claim. Okay. See, when you are disposing the actual EIS share, that gain is exempt from CGT. Okay. You can only defer the gain, CGT gain, when we are replacing it. We are investing. We are doing a reinvestment that time only. Otherwise, it's exempt. First time you sell is exempt. Occasions when the deferred gain becomes chargeable. I told you later in the lecture I will discuss you. This is that time. So EI shares are disposed of by the investor's spouse. See, following a previous no gain, no loss transfer. That means before you are disposing EI share, that share was first transferred to whom? To the spouse. When we transfer to the spouse, it is always that no gain, no loss transfer between spouse, transfers between spouse. This we studied in capital gain tax, CGT, in taxation. Don't worry, once I start teaching CGT here in ATX, I will explain that rule again. Between spouses, any transfer, it is at no gain, no loss. Following the same principle. That means, suppose I'm having the shares. First, I should dispose it off to my spouse before my spouse could dispose of the EIS share. You understand it? So first I'll dispose to my spouse at no gain, no loss. Then following that only, my spouse will dispose of the EIS share. That time it becomes chargeable. On where only part of the holding is disposed of. only a corresponding part of the deferred gain will become chargeable. Whatever the part that you're holding is disposing, only that part, that deferred gain will be chargeable, not the entire amount. Now, within 3 years of the issue of share, when is it chargeable? Within 3 years, because more than 3 years it will not be chargeable. Again, by the investor, investor spouse, and you become, the moment you become non-UK resident, deferred gain will be chargeable. For example, you are emigrating abroad. Unless it is for these reasons, then it will not be chargeable. You are working temporarily only outside the UK. Okay, you are resuming the UK residence within 3 years and you retain the share throughout. Then it is not taxable. Now, these are the conditions for you to qualify for EIS relief. Individual has to be UK resident when that gain arises and when reinvestment is made. The reinvestment must be subscribing for new shares. Okay, that reinvestment also you have to subscribe for new shares. Investment also subscribe for new share. It has to be wholly for cash. And it should be an unquoted trading company situated in UK. Now, see, this is conditions for EIS reinvestment relief. I'm sorry. I've written by mistake EIS relief. It is EIS reinvestment relief. Okay. Reinvestment has to be made within a 4-year time period, which runs from 12 months before to 36 months after the date the gain arose. 36 months means 3 years after the gain, 1 year before the gain arose. You can make the reinvestment. Claim has to be made by 31st Jan 2030 for 23-24 disposal. Why? As the date. Okay, remember the dates. Now, you have to note for EIS, income tax relief, there's a maximum investment of 1 million, correct? But for CGT reinvestment relief, there is no maximum amount. This relief is effectively unlimited. It's a good thing. And the relief is flexible. That means any amount of reinvestment relief you can claim. Therefore, individuals have to choose an amount of relief in such a way that even after choosing the relief, you have some gain left. The remaining gain is in such a way that it is equal to your capital loss and annual exempt amount. Why? Because the remaining gain also will be reduced by your annual exempt amount and capital loss, and you will be having a zero gain. That means you don't have to pay any tax. So now let us do question answers before we move on to our next part. Test your understanding 5. Here, two requirements are there. Calculate the amount of reinvestment relief and explain capital gain tax consequences of the sale of the EI share. Okay. So it is about Precious selling a painting for 275, capital gain of 150, and she subscribes for qualifying EI share in Milan Limited trading company the following month at a cost of 268. There are no other capital transactions. Capital losses brought forward from 2021 is 12,000. 3 years later, in the tax year, she sells the EI share, making a profit of 175. So first we'll calculate the amount of reinvestment relief. Okay. What is the capital gain? Capital gain is 150,000. That means the reinvestment relief that Precious could claim is up to 150,000. But she will not do that. Why? Because if she makes that 150, then she cannot utilize her annual exempt amount completely, and also the capital loss also she can't utilize. In order for her to utilize both her annual exempt amount and capital losses, will set off the reinvestment relief in such a way that she can utilize capital loss also, annual exempt amount also, taxable gain at the end will be 0. So let's do that. Capital gain is 150,000. Okay, less EIS reinvestment relief it has to be a balancing figure. Okay, what is your capital loss? 12,000. What is the annual exempt amount? 6,000. So 12 and 6 makes up 18,000. Balance has to be 18,000. So 150 minus 18 is 132,000. So reinvestment relief has to be 132,000. Let's see. Deduct a First, always deduct annual exempt amount, because this you can't carry forward or back, but and capital loss you can carry it forward. So this is 6,000, and capital loss brought forward 12,000. You see, from 18 if you deduct 6 and 12, you are left with 0. Taxable gain is 0. Okay. Now B, explain CGD consequences. So when you're disposing the EI shares, okay, there is a gain of 132,000. This 132,000 reinvestment relief. Okay, when pressures are disposing EI share, this becomes taxable. This reinvestment relief, this will become chargeable. The gain of 132,000. Okay, and what about this 175,000? The gain on the EI share, this will be exempt from CGD. Why? Because she have hold the shares for 3 years. At least for 3 years the shares were held. That's why this is exempt. And this reinvestment relief becomes chargeable. This is how it works. Interaction with business asset disposal relief. So if you are disposing, okay, an asset that does not qualify for this relief, the deferred gain could either be taxed at 10 or 20, whenever it becomes chargeable. But if the asset qualifies for this relief, taxpayer can choose to claim it now and get the eligible gain taxed at 10% when you're disposing it, or claim the EIS reinvestment relief, defer the gain until the EI shares are sold. And if this one is available, but it is not claimed at the time of disposal, you don't claim BADR at the time of disposal, you don't get it taxed at 10%, rather you choose to defer the gain. Remember, deferred gain can still be taxed at 10% when it becomes chargeable, provided certain conditions are met. What is it? Provided a claim is made within 12 months of the 31st Jan following the end of the tax year in which the gain becomes chargeable. So take the tax year when the gain becomes chargeable, take 31st Jan from that day onwards, that means 31st Jan following that year, and 12 months from that, add a 1 year to that. The decision to claim the business asset disposal, the BADR, at the time of disposal, or to defer the gain and then claim BADR later will depend on the cash flow of the taxpayer. Okay. But remember, there's clearly a cash flow benefit if you defer the gain. Okay. When you defer the gain and then tax BADR later, if conditions are satisfied, it's more beneficial from the point of cash flow, because you can hold the cash longer. No? In addition, a further annual exempt amount may be available to set against the deferred gain when it becomes chargeable. So another benefit is, first you defer, get the reinvestment relief now, then later get the business asset disposal relief also. So you defer and you are taxing it at lower percentage, 10%, and also even after that BADR relief, even after deferring the gain, take annual exempt amount also if you reduce it. Okay, you can even reduce your gain, taxable gain later on even further. You understanding? Now let us do a question. Test your understanding 6. Here you are supposed to calculate the amount of EIS reinvestment relief, and you should say whether Christine should claim it in the tax year and discuss the interaction with business asset disposal relief. So Christian is selling a 10% holding for 750. Capital gain is 250. She have acquired the share in July 20. Okay, and selling it 2023. That means she's holding it more than 3 years and has been a director throughout her period of ownership. In November, she subscribed for qualifying EI share at a cost of 375. Capital loss brought forward is 56,000. So tell me. First, you have to understand whether she's eligible for this relief or not. Whenever there's an interaction, first see conditions are satisfied or not. She might not be even eligible for it. In this case, she is eligible. Why? You have to list down the conditions. One, she has a greater than 5% interest in that company. It's a 10% holding and it's a trading company, by the way. They say it's a trading company. And what else? Hold more than 5%, trading company, owning it more than 2 years. For BADR, it's 2 years, okay? For EIS, reinvestment only is 3 years. You have to hold the share. So this is 2 years. So she have hold it for greater than 2 years. She have owned. And she works for the company because she is a director. She works also. So 3 conditions are satisfied. Therefore, she is eligible for this relief. Now we'll work out. What is the capital gain? Capital gain is 250,000. Remember, same how we have done for the previous question. If we claim 250,000 entirely, she will not be able to utilize her capital loss and annual exempt amount. Therefore, what is the capital loss? 56,000. And what is the annual exempt? 6,000. So that means 62,000 has to be her chargeable gain after deducting the EIS reinvestment relief. So the difference 188,000. Deduct 6,000 annual exempt and 56,000 capital loss and get 0 as taxable gain. Remember, this deferred gain will be taxable later on. It will be chargeable in the future. And when it becomes chargeable in the future, it will be taxed at 10%. Why? Because the gain would have qualified for business asset disposal relief. And if you are holding the EIS share for 3 years, okay, then if the value of the EIS share increases, that will be exempt from CTD. And capital losses also will be allowable. Alternatively, Kristen could do this also. She might not choose EIS relief and claim BADR in the current tax year. It's possible, but remember, if she does that, it depends on her cash position. In terms of cash, it might not be most suitable, or it's not a wise decision to make. Okay. Now, withdrawal of EIS relief. You can withdraw this relief also. The income tax relief is withdrawn if the EIS shares are not held for a minimum period of 3 years. In this case, if the investor sells the shares within 3 years, investor must repay to HMRC the income tax relief given. Earlier, HMRC has given the income tax relief. Now you have to repay it back to the HMRC. It's 2 conditions, at arm's length or not at arm's length. If it's not at arm's length, okay, this is how it works. This is how the amount would be. Income tax relief withdrawn means amount of income tax that becomes payable. If it's not at arm's length, all the original income tax relief given will be now payable. If it's at arm's length, then the income tax that is payable will be lower of original income tax relief given, or 30% into the sale proceed received for the shares. Whichever is lower will be payable. We'll do a question definitely on this. Now, any income tax relief claimed and not withdrawn is deducted from the cost of the shares for CTT purpose. For capital gain tax purpose, you deduct from the cost of the shares for CTT purpose. Now, Inheritance tax. Now, shares in an EIS scheme qualify for a business property relief. In inheritance tax, we have a relief known as business property relief. This is only for business property. Certain conditions are there. If you can recall EIS share, I mean inheritance tax. We haven't finished inheritance tax yet. I've not covered it. That is after I finish capital gain tax. First is income, capital, and inheritance. There, I will explain you in detail how business property relief works. But for now, know that EI share also qualifies for business property relief. One kind of relief under inheritance tax, as they are unquoted shares, and they have to be owned for 2 years. Now, it's a summary. So, EIS reinvestment relief. You get a relief for gain on the disposal of any asset where proceeds are reinvested in qualifying EI shares within the time period. What is the time period? Reinvest within the 4-year period, 1 year before, 3 years after the date of sale. Claim for 23-24 by 31st Jan 2030. Conditions. For individual, you have to be UK resident when the gain arises and when the reinvestment is made. Both the time you have to be a UK resident. And investment, subscribe for new shares. Wholly for cash. Amount of relief, lowest of the capital gain, the amount invested, and any smaller amount chosen. Operation of relief, the gain is deferred until a later date. Any amount that is not deferred will be charged. Deferred gain is frozen until the disposal of EI share, could be by the investor or spouse, or investor or spouse who becomes non-UK resident within 3 years, then deferred gain will be chargeable, and deferred gain is then taxed at 10 or 20% if BADR is not available at the disposal date, at 10% if BADR is available, and the gain on the EI share is exempt provided it is owned for at least 3 years. Now, next, seed enterprise investment scheme. So we are moving from enterprise investment scheme to seed enterprise investment scheme, SEIS. Okay, this scheme is similar to EIS. That's why first study EIS, then come to SEIS. It would be very easy for you to learn. And this is designed to encourage investment in smaller startup companies. So to qualify for the scheme, investor must subscribe in cash for new ordinary shares in a qualifying company, same like EIS. She should not be a current employee. Same like EIS, but the difference is can be a director or a previous employee. Should have an interest of 30% or less. Same like EIS. Tax consequences, income tax. There, 30%, here you are getting a 50% relief. Max 100,000. There it was 1 million in EIS. Amount is reduced. So that means maximum tax reduced as 500,000. Their maximum was 300,000. Data from income tax liability, same. You can reduce the liability to nil but cannot create a tax repayment. And an investor can carry back amount invested to the previous year. Same like EIS. But you cannot get relief on more than 100,000 in any one tax year. Same. Only the amount is different. Now, claim for SEIS income tax relief. This relief is also made under self-assessment tax return up to 5 years after 31st Jan following the end of the tax year in which the shares are issued. Same. For 23-24 shares issued, you have to claim at 31st Jan 2030. Capital gain tax. This is like EI share scheme. Gains on shares held for at least 3 years will be exempt. There also 3 years exempt, here also 3 years exempt. And you can make an election. There, capital losses are always allowable. Here, an election has to be made. I mean, that is for income tax. But for capital gain tax, there also you have to make an election. Here also you have to make an election. Can be made for capital loss to be relieved against total income like trading income. Like trading losses, I'm sorry. Now let us do a question. Test understanding 7, a very simple question and very straightforward. So Imran subscribed for qualifying SEIS costing 60, income tax liability is 37. How much of the relief she will get? So it is 50% on 60,000, which is 30,000. So from 37, you reduce 37,000. Sorry. Now, capital gain tax SEIS reinvestment relief. This works differently from EIS, although in many respects it is same. If an individual disposes of any chargeable asset which gives a rise to gain, reinvest the process in qualifying SEIS, this are same, and qualifies for SEIS income tax relief in the same tax year, then some of the gain is exempt, not deferred. Some is exempt from CTD. This last condition is different to EIS. It was not there in EIS. EIS you can always defer. Here you have to qualify for SEIS income tax relief also in the same tax year. Then you don't defer, but some is exempt. Remaining gain is taxable. If an investor elects to carry back the amount invested in SEIS share to the previous tax year for the purpose of SEIS income tax relief, this will also apply for the purpose of SEIS reinvestment relief. So if you are carrying it back for the SEIS income tax relief, same will apply for SEIS reinvestment relief also. It will be carried back. This means if an investment in EIS share was made in tax year, but a claim was made to carry back the investment and claim the income tax relief in the previous tax year, reinvestment relief also would be available in respect of the gains made in the tax year 22-23. Now, how does this relief works? Maximum exemption is 50% of the lower of amount of the gain, amount reinvested in qualifying SEI shares on which income tax relief is claimed. As the amount that qualify for income tax relief is 100, maximum CGT exemption is 50,000. Okay. Remember, this relief is not automatic. It has to be claimed, but it is flexible. How? You can make any amount of reinvestment relief you can claim. So as any amount up to the maximum reinvestment relief can be claimed. Now, therefore, if applicable, the individual should choose an amount of relief in such a way she can utilize capital loss and annual exempt amount also. Time limit for making the claim is same as for EIS reinvestment relief, that is for disposal of the tax year in 23-24, it is 31st Jan 2030, and inheritance tax. Shares in an SEIS qualify for business property relief. This is same for EIS also, as they are unquoted shares and they have been provided they have been owned for 2 years. Now let us do a question. Test understanding 8. You have to calculate the taxable gain of Zosias, assuming the SEI shares of 60 and 125. Explain the CGT consequences if Zoya sells SEI shares in 2028. So she have sold a vase in June 2023 for 150. Capital gain is 75. And capital loss brought forward is 22,000. Okay. So we'll make with 60,000 and 125,000. Capital gain 75,000 under both. This is the SEI shares cost. Now, less the reinvestment relief. SEIS reinvestment relief. There is a working to it. Here, now you can't do like how we used to do for EIS, where we took the balance and we took annual exempt and capital loss. That you can't do here. Here there is a limit to it. Here there is an exemption. So we'll do that working. Okay. The gain is 75,000 This is the gain under both. And amount invested in SEIS qualifying for income tax relief. How much income tax relief you will get? Amount invested in SEIS qualifying for income tax relief. How much would be qualified? Here it is 60,000 cost. Here it is 125. Remember, max is 100,000. So here 60,000 she can do. Amount she can invest in SEIS is 60,000, for which income tax relief she will get. But max is 100,000. Remember, beyond 100,000 she can't invest. It's the max. Okay. So the CGT exemption, it would be 50%. 50% on the lower of this two amount. So out of 75 and 60, lower is 60. So 50% of 60 is 30,000. This 30,000 is exempt. CGT exemption. And from 175, lower is 75,000. So 50% of 75,000 is 37,500. This is CGT exemption. This will work right here. 30,000. It is exempt, okay? Now chargeable gain. CG. 45,000. 37,500. Now we'll deduct annual exempt and capital loss. So it is 6,000. 6,000. And here it is 22,000 and 22,000. Capital loss has been 22,000. 17,000 and 9,500 is the taxable gain. Now, there is a thing that you have to note, especially in the second scenario where the cost was 125,000. So here, if Zoya's capital loss was more than, what was the amount here? 37,500. From here you deduct 6,000. So from 37,500, if you minus 6,000, you are left with 31,500, right? And you are having a loss of 22,000. So if you're having a loss of more than 31,500, what happens? If the capital loss was more than 31,500, Zosia could claim up to 37,500 exemption. She can do that. But could choose instead to restrict the claim. Okay, maximum she could claim is 37,500, but she choose instead to restrict the claim to preserve the use of capital allowances and annual exempt amount. That means up to 37,500 she could claim, but rather she restricted it because she wants to use her capital loss and annual exempt amount. It is not much an important thing, but knowing it is always good, knowing the background. Now, sale of SEIS share. Explain the CGT consequences. Here you have to explain. So when you are there selling, is it exempt or not? There will be no gain. No gain. When Zosia says the SEIS shares in 2028, there will be no gain. Why? The gain that was subject to reinvestment relief will not become chargeable. As SEIS relief is an exemption rather than deferral. Remember, it is exemption. SEIS reinvestment relief. It is not EIS reinvestment relief. Here it is deferred and later chargeable, but here it is exempted. So it will not later be chargeable. You understanding? Therefore, there will be no gain. and the gain on the SEIS share will be exempt from CGT as the shares has been held for more than 3 years. Now the withdrawal of SEIS relief, and this we have done for EIS also. So if an investor sells the shares within 3 years, income tax relief and any CGT reinvestment relief will be withdrawn. Income tax relief claimed and not withdrawn is deducted from the base cost, deducted from the cost of the shares for CGT purpose. You have to see whether it's at arm's or not at arm's length. If it is not at arm's length, for income tax relief withdrawn, all the income tax relief given, you have to pay back. And for CGT, that means previously exempted gain that becomes chargeable. All of the gain previously exempted will be chargeable now. And if it's at arm's length, then income tax relief withdrawn will be lower of original income tax given, 50% into the sale proceeds received for shares. And for CGT, a proportion of the gain previously exempted. This is how you work out the proportion if it's at arm's length. Amount of income tax relief withdrawn divided by original income tax relief given. Okay, we'll do a question on this. Now, let us summarize. So, relief for gains on disposal of any asset, proceeds reinvested in qualifying SEIS shares within time period. Time period, reinvest within tax year of disposal. Claim for 23-24 by 31st Jan 2030. Conditions. Individual has to be UK resident when reinvestment and when the gain arises. Investment, subscribing for new shares wholly for cash. Maximum amount, 50% in the lower of capital gain. Amount invested and qualifying for income tax relief. Any smaller amount can be claimed. But you have to take 50% of all those three and compare which is lowest. Operation of the relief, gain is exempt. Amount not exempt is chargeable. Gain on the SEIS is exempt if you are holding it for at least 3 years. Withdrawal of the relief, you are selling the SEIS shares within 3 years. Now, so this is how it works. If it's not at arm's length, then income tax relief and CGT relief, all you have to pay back. And if it's at arm's length, for income tax relief, it is lower of the all or 50% of sale proceeds received, and for CGT, it is the proportion that you have to pay back. Proportion is income tax relief withdrawn divided by income tax relief into gain. Now let us do a question. Test your understanding 9. Here, Zosia is selling to her sister not at arms to her friend at arms within 3 years. From test understanding 8, you have to bring this. Okay, you need your test understanding 8 question. Assuming that now she's selling it in 2025 for 65. You have to consider both the situation at 60 and 125,000. Now under both the scenarios, income tax relief and CGT relief will be withdrawn because it was sold within 3 years. So we'll do both part. Let's do. Okay, not at arm's length. If it's not at arm's length, what did the table say? Entire income tax relief has to be withdrawn. That means whatever relief is given to you will be now payable. Same for CGT, the entire amount. So it is at 6,000 and 125,000. These are the cost. Income tax relief withdrawn. How much was it? 30,000. Because it has to be 50% on that amount. 50% of 60,000. And then here it will be 50,000 because it is 125. Maximum relief is for 100,000. So 50% of 100 is 50,000. Now CGT. For CGT relief it is 30,000 and 37,500. This we have worked out before. Okay, this was the exempt tax. Now part A is over. Coming to part B. It is in arm's length. Okay, so now you have to take the lower of. Okay, now So original, if you see, it will be this only 30, 50, 30, 75. It's from A, part A. Next, so income, you have to choose the lower of the original. So original, that means from A, part A, 30,000 income tax relief. Okay. Next, this is A, second part, 50%. That means lower of this two amount you have to take. 50% of the sale proceed received for share. So 50% sale proceed is 65,000. So it is 30 to 500. Which one is lower? This one. This one. A. All income tax relief needs to be withdrawn because this is lower. Lower of first and second you have to choose. And for CGT, sorry, for 125. Originally it was 50,000. Here 50%. Here it will be 32,500 only. 50% of sale proceed. This is lower. That is income tax relief withdrawn. Income tax relief withdrawn. This is when it is at arm's length. Now CGD withdrawn. So here it is percentage of income tax relief withdrawn into gain exempt. Percentage of income tax relief withdrawn into gain exempt. So what is it? What is the percentage of the income tax withdrawn? 30,000. And all it is 30,000. Original income tax relief given 30,000, 30,000, 30,000 into the gain exempt. So this percentage is 100%. 100% of CGT relief is withdrawn. So we have already chosen 30,000. No, 100% means 30,000. 30,000 is the CGT relief withdrawn. Because 30,000 was the exemption claimed. Then, when it is at 125,000 cost, what is the income tax relief withdrawn? This one, income tax relief withdrawn is 32,500. Divide by income tax relief claimed. Claimed is this 50,000. Because here it is same, that's why it's 100%. Withdrawn is also 30. And income tax relief claimed is also 30. But here you have claimed 50. So it is 65%. So 65% into the gain exempt. What is the gain exempt? 37,500. Which is 24,375. This is the gain exempt. You can get it from here. This one. This one was the gain exempt. And this one was 30,000. So if you take 100% of 30, it is 30,000. Because this formula is into gain exempt. So 100% into 30,000. That's why we are getting 30,000. And here it is 24,375. So CGT relief withdrawn is 30,000 and 24,375, and income tax relief is 32,500 and 32,500. Sorry, 30,000 and 32,500. It is little, it could be little complicated, but try keep doing questions like this, okay? The third one, venture capital trust. So we have finished EIS, SEIS. Now we are moving to the last one, venture capital trust, VCT. This is introduced to encourage investments to provide capital for unquoted trading companies. This is VCT is a quoted company, okay, that buy shares in a EIS company. So an individual is able to invest in a spread of unquoted companies. This reduces the risk because rather than investing in one company, it is better to invest in separate companies. So your risk is spread. Tax consequences, income tax. Same like EIS, 30% into the cost of shares. Maximum investment is 200,000. Please remember the maximum investment under each. For EIS, it was 1 million, SEIS 100, and for VCT 200. Therefore, maximum tax reducer 30% of 200, 60,000. Beyond this, you can't reduce. Deduct from income tax liability, can reduce to nil but can't create tax repayment, no carryback facility. Unlike EIS and SEIS, VCT does not have a carryback facility. Now, you can claim the relief within 4 years, 1 year, within 4 years of the end of the tax year of investment. So this does not have 1 year before and 3 years after the sale. This is straight away 4 years of the end of the tax year of the investment. That means for any share that you have purchased in the tax year 23-24, it will be by 5th April 28 because tax year ends 5th April 24. 4 years from then it would be 5th April 20. Now, dividend that you are getting from VCT are exempt from income tax up to 200,000. Exempt from income tax for investments up to 200,000. CGT, capital gain tax. That means when you're disposing the shares in a VCT, even they are exempt for investments up to 200,000. No relief for capital losses. We had relief for capital losses in SEIS and EIS, not under VCT. You can't even defer. And inheritance. Shares in VCT, they do not qualify for business property relief, but EIS and SEIS qualify. Now, how do you withdraw? You withdraw, the income tax relief is withdrawn if the shares are not held for a minimum period of 5 years. This is not 3, this is 5 years. If it is not at arm's length, all the amount. And at arm's length, lower of original income tax relief given 30% into the sale proceed. Now, comparison. This is a very good tool for you to do a revision of all the three. It's a good comparison. Level of risk is high because only you are investing in one company, both for EIS and SEIS. But for VCT, it is not as high because risk is spread over a number of investments. Qualifying individual. Both EIS and SEIS subscribes in cash. Both are into new ordinary shares. Both are qualifying company and both has to own less than or equal to 30% of ordinary share capital. Whereas VCT, same subscribe in cash, newly issued shares. And remember, for EIS, they can't be an employee or a director. EIS. And they're independent of the company prior to first issue. Whereas SEIS, they are not current employee, but they could be previous employee or director. Now, maximum investment, 1 million, 100, 200, all these are annual amounts. Retention period for income tax relief, 3 years. That means you have to hold the shares 3 years. If you are selling within 3 years, income tax relief will be withdrawn, and for VCT it is 5 years. And income tax relief you deduct from income tax 30%, 50%, and 30%. So EIS and VCT are 30, SEIS is more 50%. Now, what is the amount that you can carry back? Any amount invested, no relief if you are investing more than 1 million in any one tax year. Any amount invested, no relief if you are investing more than 100. No carryback. Dividend income, taxable for both EIS and SEIS, but for VCT it is exempt. And CGT on disposal. Gain is exempt if it is hold more than 3 years. Loss is allowable. You can elect to convert it into income tax loss so that you can set it off against trading income. Okay. Now, no gain or loss regardless of when sold. Okay, it is exempt. Doesn't matter when you are selling it. There are no gain and loss. Now, CGT relief. Gain on any chargeable asset are deferred if you are investing the proceed. I mean reinvesting the proceed in the EIS share. Gain then becomes chargeable when you're disposing EIS share. Here up to 50% is exempt. And relief is withdrawn if SEI shares within 3. No relief. For BPR, both are business property relief, EIS and SEIS, provided they are owned more than 2 years. And business property relief is 100%. But for VCT, there are no business property relief. Now let us do a question. Test your understanding 10. Here you have to calculate income tax liability. Very easy question, but it has lots of things. We have dividend from VCT investment, dividend from RET, dividend from IIP trust, discretionary trust income, back interest. Both trust assets comprised of quoted shares only. He invested 50,000 in EIS share. Private pension contribution is 13,260. Trading income is 90. Okay, so all these are investment income. Let us do. So now we'll list all the incomes first under the heading trading income is 90,000. Then we have bank interest of 458. This is savings. 458. Then we have income from VCT exempt. This one will be received net. We have to gross it up. 4. So REIT 4992. 100 divided by 80 because it is received basic rate at basic rate 20%. 6 to 420. Remember when we are putting the incomes here, all are gross. All gross income you have to put. Then discretionary trust income. Discretionary, I haven't covered trust income yet here. I'll be covering it soon in my future lecture, but discretionary trust income and dividend from IEP trust, they are received net. Okay. So first one is IEP trust. IIP trust is received net of basic dividend. Okay. So what is the basic rate of dividend? It is 8.75. So the net will be, when you want to gross it up, it would be 91.25. So IEP trust 2205. 2205 multiplied by 100 because it is of dividend rate, it is netted off. Dividend basic rate is 8.75. So 91.25 is 91.9. This is always from IEP trust. Always receive net. So 2416. Then we have discretionary trust income. Discretionary trust income are received net of additional rate. It's always fixed for discretionary. When we go through trust income, I'll explain you in ATX, but in taxation it was there. So if you can recall your taxation knowledge, it would be 100 divided by, what is the additional rate? 45. So it's 55. That's how you gross it up. 6,000. And if it is exempt, VCT dividend, you have to write it as exempt like this. 0. So if you add all of this, okay, what is the 105,114? Okay, less personal allowance. If you see this total income is more than 100,000. So in my first lecture, I've told you if it's more than 100,000, personal allowance will reduce. But we have to calculate adjusted net income, ANI. If that exceeds 100,000, then only personal allowance will reduce. What is ANI? We need a working for it. Okay. So let's quickly do that. See here, he made a private pension contribution. So by this, the amount this you have to add. This will be added. Okay. So how do you work out? It is 13 to 60. It is net. It's private pension. So you have to gross it up. It is 16,575. So what is the amount? 105 net income minus 16,577, the gross amount of pension, which will be 88,539. So your net income is not exceeding 88,530. It is not exceeding 100,000. It is 88,539 after taking the gross personal pension contribution. So therefore, full personal allowance you will get 12,570. And also the basic rate will be extended by that amount, 16,577. So with 37,700, you will add 16,575. Now the basic rate would be 54. Up to 54, 275 would be taxed at 20%. This is the extended basic rate. This is what happens when you're making a pension contribution. So here personal allowance would be 12,570. After this, taxable income 92,544. Please do it for yourself and check. Are you getting the correct answer or not? Taxable income, TI. On this, you have to pay tax now. So now, let us do the tax. When we do the tax, always categorize it in the correct category. Analyze of income, dividend, savings, non-savings. There are three incomes here. So first, always non-savings, okay? Non-savings. So from non-savings, see from here, it's very easy to work out. Just take out the savings, which is 458, and the dividend out of it. What is dividend? How much? 2416. 2416. Only the dividend from IE trust will be taken out. Dividend from REIT is taken as non-savings. Discretionary trust income will be taken as non-savings. Understanding? So 92,544 minus 458 minus 2416. It would be 89,670. So here, basic rate for non-savings. First, now extended basic rate you have to take. 54,275 would be taxed at 20%. 10,855. 89,670. So the balance 35,395 would be taxed at 40. 14,158. This is at higher rate. Now we are coming to the savings. Savings nil rate band is available. So this entire amount 458, because savings nil rate band is 500. He's a higher rate taxpayer. You understanding? This is 458. So if he's a higher rate taxpayer, looking at the taxable income, you can make it out. Savings nil rate band will be up to 500. So 458 is less than 500. So the entire amount would fall under nil rate band at 0%. 0. Now dividend nil rate band 1000 irrespective of anything is 0. The balance dividend. So 2416 out of 2416, 1000 went. Now 1416. What is the higher rate for dividend 33.75, 478. Add all this 25,491. From here, EIS relief now you can reduce. How much investment he made? 50,000. This is EIS. Up to 30% of 50,000 you can reduce from income tax liability. So 30% of 50,000. That was 15,000. EIS relief. This is EIS relief. 10,491. This is your income tax liability. So now we have come to the last part of this lecture, tax efficient income. There are different forms of income. As there are different forms of income, the areas of consideration also will vary. Okay. There are range of exempt income. There are range of, there are exempt sources of income, and then there are tax exempt benefits. Different tax rates are there on alternative sources of taxable income. So these are some tax efficient expenditure. If you spend on them also, it's tax efficient. First one is personal pension scheme. Pension is, by the way, my next lecture. It's going to be my lecture 7. Minimum tax relief is 45%, and it is beneficial for higher rate and additional rate taxpayer. How you can extend? Just now we saw in the test understanding 10 question where we extended the personal pension. We extended the basic rate by the gross personal pension contribution that we have made. So you can extend the basic rate and higher rate. Remember, additional rate ban you can't extend. Okay, so that's why the minimum tax is 45%. That is additional rate that you can save. Next, occupational pension scheme, again 45, but you don't extend the rates. If it's occupation, you get it relief through pay as you earn. The moment you contribute into that, it will automatically be deducted from your income, and then the amount will be given to you. Qualifying loan interest, 45% on up to the greater of 50,000 or 25% of adjusted taxable income. ATN. This I've explained in my lecture 1. Please do watch. And deduct from total income. Okay. Next, EIS, SEIS and VCT, 30, 50, 30. Up to 1 million, 100 and 200,000 investment. That's the minimum tax relief. And you reduce it from tax reducer. Deduct from income tax liability. Now, let us summarize this whole lecture. Property income and tax efficient investment. We went through allowable deductions, then furnished holiday accommodation where we went through condition, how much it has to be actually let and available for letting, and the reliefs, rent a room relief, the 7,500 rule. I call it 7,500 rule. Okay. Then short lease premium. Then losses only against property income you can adjust, and real estate investment trust, which is received net of 20%, and it is taken as non-savings income, not dividend. Then individual savings account up to 20,000 tax free, can transfer to spouse on death, EIS, SEIS, VCT, 30, 50, 30, and also some conditions, reinvestment relief, when the tax is withdrawn, impact on income tax and capital gain tax and inheritance tax. So make sure you, after watching this lecture, you go and pick up your revision kit and start doing questions from it. Thank you for watching, and I shall see you in my next lecture, which is pension. And don't forget to subscribe to my channel if you haven't subscribed. Thank you and God bless.